If you told me I could only own one stock for the rest of my life, no ETFs, no diversification, no asset allocation, just one single company, I think I already know my answer. It's not a tech stock, it's not flashy, but it's been quietly compounding wealth for decades through every kind of market condition. Something to say in advance is that I would never invest in a single stock if I had the option to diversify further via ETFs, commodities, bonds, all the things that we talk about in the channel. But if I had really to invest in one and only one stock, what would it be? And in this video, I will explain why. It is the most rational one stock portfolio pick I can make. I will talk about its financial strength and the actual risks, because yes, there are risks, there are a few. How it compares historically to the S&P 500 and how it holds up during crashes. So let's dive in. Now first, why even ask the question if I could only pick one stock? If I would never do it, as I said before, and I would have the option to diversify across multiple assets, it is because it forces you to focus on the core traits of a business. Is it durable? Is it diversified? Is it well run? And can I sleep at night holding it through a crash? This is about conviction, long-term thinking, and quality. So while it's a theoretical question, it tells you a lot about someone investing philosophy. And for me, the answer is clear. It's Berkshire Hathaway. So Berkshire Hathaway isn't really one company. It's a holding company made up of dozens of world-class businesses across multiple sectors. You're not just buying insurance, you're buying Geico, BNSF Railway, Berkshire Hathaway Energy, Precision Castparts, and major stakes in companies like Apple, Coca-Cola, and American Express. It's like owning a diversified mutual fund, so it really aligns more with my diversification philosophy, except there are no management fees, and capital is allocated by one of the greatest investors of all time. If we talk about financials, I analyzed the latest 2024 10K, and the first thing that pops up is the breakdown of industries across the different companies that make up Berkshire Hathaway, based on contribution to operating earnings. So if we look at the distribution, insurance makes up about 48%, railroad 11%, energy 8%, manufacturing between 15 and 8% and 18%, service and retail between 7 and 10%, and others about 3%. Non-control business means companies where Berkshire Hathaway has a stake but doesn't control, and this includes companies like Kraft Heinz and Occidental Petroleum. One of the reasons I would bet on Berkshire Hathaway is the balance sheet. If we look at assets and liabilities overall, we can see 1.1 trillion in assets and 500 billion in liabilities, which makes shareholders' equity 650 billion, which is unbelievable. If we look at cash equivalents, and debt, with cash plus T-bills 3 times larger than total debt, and yes, that's right, 3 times larger than total debt, Berkshire could fully repay its obligations without touching investments and operations, which is just exceptional. And this signals, again, exceptional liquidity and very low default risk, which is something that we want in the companies that we invest in. Now let's look at the performance numbers. If we look at the overall performance, we can see the portfolio growth of 10K over more than 35 years since 1998 is slightly higher for Berkshire Hathaway, so about 2 percentage points in comparison to the S&P 500. So now let's take a look at different metrics. So you can see here the starting balance that we talked about before, the annualized return over this period since 1998 for Berkshire Hathaway was about 12%, the annualized return, versus 9.2% for the S&P 500. This is interesting because over the last few months, there's been an overperformance of Berkshire Hathaway in comparison to the S&P 500, and this is because the heavy tech sector allocation of the S&P 500, which is not so heavy for Berkshire Hathaway. If we look at the best year, 52% for Berkshire Hathaway versus 33% for the S&P 500. The worst year is slightly better for Berkshire Hathaway, 32 versus 36% drawdown, and the maximum drawdown is 45% versus 50% for the S&P 500. So you can see here the Sortino ratio, which is sort of a risk-adjusted return measure, is much better for Berkshire Hathaway, 0.94 in comparison to the 0.75 for the S&P 500. So overall, better risk-adjusted returns better returns and lower risk overall than the S&P 500. So how does it hold during periods of market stress? And this table tries to outline the different crises that we've had since 1998, 1997. And you can see that there is a mixed bag, right? At the beginning, in the Asian crisis, the Berkshire Hathaway just dropped double than the S&P 500. But overall, after that, it's been even or either better or similar drop downs than the S&P 500. So, for example, in the dot-com crash, similar to what we are seeing now, because they have the tech-heavy allocation of the S&P 500, it was a 44% drawdown versus an 11% drawdown for Berkshire Hathaway. During the subprime crisis, more or less the same, and during the COVID-19, it was more or less the same as well for both. So overall, I think it's a mixed bag again, but in recent times, the risk-adjusted returns or the behavior during crisis has been better for Berkshire Hathaway. Now, let's be clear, there are risks. And let's talk about those identified in the financial report first. There is, catastrophic insurance events like hurricanes, wildfires, and this is expected as they have a big stake in insurance. There is market volatility, pretty normal, affecting investment portfolio, which is normal for every single company. And there's regulatory changes, especially in insurance and energy, which are highly regulated industries traditionally. So this could have a bigger impact on Berkshire Hathaway. And then cyber attacks and geopolitical shocks, crime-related damages, which affected in 2024 the property and casualty pricing. And there are others which are not mentioned in the report, but I think are important too. The first one is the succession risk. Warren Buffett is 94 and Charlie Munger passed away recently. And Greg Abel is next in line and he is capable, but this is still a generational shift. There's a size problem as well. Berkshire Hathaway is massive, so finding acquisitions that move the needle is much harder right now. Insurance exposure, a large portion of the business is still in insurance, which can be hit hard by unpredictable events. Insurance operations represent almost 50% of their total operational income, as we have seen, and this is obviously a risk, a concentration risk. Market sentiment, Berkshire Hathaway doesn't always look sexy to growth-hungry investors, so the price may lag in bull runs, as we have seen recently as well. But this could be a positive if the market goes the other way. But I still believe the intrinsic value growth over time outweighs these concerns, in my opinion. So right now, I use Berkshire Hathaway as a core holding in my real portfolio. It sits alongside global equity ETFs, dividend funds, gold, and managed futures. But if I had to go all in on one stock, Berkshire Hathaway would still be the answer. It gives me things like sector diversification, defensive earnings, strong capital allocation, and long-term compounding potential. It's a stock that actually lets me sleep at night. I know it's not exciting, but it's a disciplined, durable, and rational business and a rational decision as well. And that's exactly what I want from my investment. Now I want to hear from you. If you could only pick one stock, what would be it? It would be Berkshire Hathaway, it would be another one. Leave it in the comments. I'll be reading and reply, and see you in the next video.